Hello, everyone. Welcome back to the Trading Room. I'm Shane Vernier on this howtotrade.com. I want to really extend a warm welcome to everybody that's joining us here this evening. This is the Asia Pacific preview. This is a stream that we used to do for years, and I decided to throw a few more back in the mix today. We're going to cover the FOMC minutes. We're going to break that down. Fed officials were divided on the decision last month. Really showed up in today's minutes. We're going to go over a few things that are important to remember as we move forward. Also, we've got some trade updates. We've got a lot of trade ideas to go over, and I want to really show exactly what exactly we're trying to get accomplished here. In the trading room, first and foremost, it's education. We're looking to point out and give you strategies. We're also looking to make a few market reads and put out our actionable trade ideas that come out typically 2 a day. When Connor gets back, it'll be 2 a day. For right now, it's just 1 a day. I'm sort of picking up the slack, double duty, but that is okay with me. I don't mind it, so I want to welcome everybody back, and let's go ahead and get started here. We've got a couple of things that we need to review right away, and let's start with some trade updates. Barnacle, good to see you, Barnacle. I hope everything's going well. I think it was an interesting day on the markets, that's for sure. We're going to get right to it. Mark Corp, good to see you. Mark Corp, Bobby Bob, all right. We've got WTI crude oil on tap today. We're going to talk EIA inventories numbers. We're going to go FOMC minutes. We're going to talk US dollar. Dragon, good to see you, Dragon. We're also going to look at the yen, and we're going to look at that Euro-kiwi trade that we had sort of pointed out that I think is going to come into range here relatively quickly. So we're just going to get started right now. We did a Pendulum stream earlier today. If you need a place to trade, be sure to check out Switch, 100% bonus. Check it out. Boost that purchasing power. It's a big part of being a successful trader. It's having enough money to put on the trades and make enough money to make it worth your while. We went over the Pendulum strategy earlier today. It was a good day for a strategy session. I wanted to get in there and really just go over what exactly Mario Singh's Pendulum was, and we did that. And in the earlier stream, we outlined a few different trades. Well, this trade's already gone live, and I had a feeling that we were going to get a shot to get one of these trades live after the FOMC minutes. So remember this dollar Swissy. If you missed the earlier stream, go back, check it out. Fast forward in there until we get to some of the Pendulum calls. We did 3 markets, and this is the only one that's live right now. This is an interesting trade. You've got a nice daily, what I would call a daily spike low to a daily spike high right there, and that's sort of what we were really trying to work with here. Nice big move today on the FOMC minutes, and then we sort of came down. So remember, with the Pendulum, what do? We identify resistance, we identify support. When we hit that level, when we check out resistance and then come back 10%, we sell it, and that's exactly what happened here. This is a sell scenario. This isn't a buy scenario, and this trade's live. So right up there, we were looking at 86.06 was the top of that market. We went to 86.09, and then we came came back down. I think that is definitely an active trade in my book if I'm trading the pendulum. So let's go ahead and throw up the 30-minute chart, and you'll see exactly what's happened so far. We sort of had that nice big rally on that FOMC minutes, and then a little bit of chop, and then we came back down, and right there we sort of got elected into our short. So the sell would have been right there from 85.99, and we've bounced back up, guys. We're only 6 pips off. I expect this market to come down a little bit, and if you want to see exactly what the trade looks like, we did put the stop losses out there and the profit targets. Remember, pendulum strategy has 2 stop losses. Has 1 stop loss, 2 profit targets. That's our entry, 85.99 sell. First profit target, we're looking for 85.67. The second one's 85.36. I'm fixated on the first one. Mario Singh says you need to be, you stagger it. You take half your position off at 50 and the other half of 90 of your range. That would be our range. I'm not interested in that. I'm looking for the 50%. Why? Because it's going to give me a shot at about 30, 32 pips. And that's right in my wheelhouse. So remember, 85.99 was your sell, 30.86.31. That's about 32 pips. That's your stop loss up there. And if we get stopped, we get stopped. Remember, anywhere from 1 to 3% of your trading account on any one given trade. For me, I typically am a bit more aggressive. I look from probably 3%, 3 to 5%, probably not much more than that. But on a trade like this, you can max that thing out at about 3%. Give yourself a chance to make a few bucks, 32 pips. If you use your ideal leverage, you got a pretty good chance to make a little bit of money here. I'm watching closely. I'll be watching yesterday's high. I sort of expect a failed auction and us to sort of rotate back down in here. But we just got to wait and see how this range holds up. If this is, in fact, a breakout and you see the dollar really start putting on a show against the Swissy, which I would be surprised. But if, in fact, it does, then we'll get stopped out, and that's just the trade. That's life. So that's Mario Singh's pendulum. I wanted to start off by reviewing that trade because it is live. Let me see. Dragon 131, looking to trade the piranha during the Tokyo session. Well, all right. Trading the piranha on the Great Britain pound USD. You're going to go on that dollar yen. It's up to you. Remember, take these strategies. They're a jumping off point. Take these strategies, apply them to whatever market you want. Apply them to the time frames you want. Just do some back testing first. These things are just a jumping off point. Remember, your creativity as a trader is your number one asset, your number one attribute. I've been sort of looking through our YouTube channel and seeing some of the comments that have been coming in on the 9 EMA videos. And there's a lot of positive comments. There's a lot of negative comments. And typically the negative comments are from traders that don't want to think. They don't want to think. They say, crossover strategies don't work. That's not true. Crossover strategies can work. 9 EMA strategies can work. The whole thing is your risk versus reward. And when you put these things on, I would be focused on a crossover, a 9 EMA if I was going to trade it, 30-minute chart U.S. session, and I would back test and run the numbers for the past 60 sessions and see what happened. I'd be looking to do that on the U.S. indices. Would it work? More than likely, yeah. You just got to dial in your risk versus reward. But you have to think to be able to do that. So I'm sort of giving a shout out to some of the folks that have been leaving rough messages. I really don't care. I'm a big boy. I can take it. But you guys got to start thinking. And you guys out there, you know who you are. We got a lot of guys in the trading room, ladies and gentlemen, that can think. You got to be able to think. If you can't think, you're going to fail. That's the bottom line. Nobody's going to spoon feed you a winning strategy. They're not. We're showing you things you can do to get going. And that's all it's about, guys, is just getting going. So using the prawn on the Tokyo session, I love it, Dragon. Keep me posted. Let me know how it goes. And all the best in your trading. All right, guys, we got a couple other trade ideas to do a quick follow-up. I want to follow up on these because this dollar yen one really disappointed me. I thought we were going to get a very beautiful pullback here. This was sort of the daily. This was yesterday. This was a nice daily. Really a nice daily range on last week's range. And I was looking for a 38% retracement right back into last week's range. And you can see by that doji, we were pretty close to getting it. And we just didn't quite get it. And you can see exactly what happened here. So in this instance, you can see right there, spike low, spike high. There's your doji. That sell-off, it was a pretty good one. We just didn't quite get there. Your low, 147.34. We're looking to get in there right above 146.25. It sounds like, oh, geez, Shane, that's about 100 pips off. I said, yeah, but if we do get that move, or if we would have got that move, a lot of confidence in our entry being a good one. A lot of confidence in it, and that's part of the deal, guys. A lot of times They pay us to wait. They don't pay us to trade. And unfortunately, we're sort of left out in the cold because this doji right here sort of was a signal that, yeah, we're going to continue the trend. The dollar against the yen, I would be long this pair. The question is can we get an entry anywhere on it? And this is not the best market structure I've ever seen, but we got to manipulate the chart. That tells us it's pretty tight when I have to blow it up for us to see it. But right there, spike low. 148.84. Do we get a chance there? We might get a chance there. Love the 4-hour chart. 4-hour chart on Forex pairs is one of my favorites. Spike low right there, spike high, pullback, 148.84. Would absolutely love that trade. So I'm watching that pretty close, but unfortunately the last trade idea we had out for the yen, we're going to have to strike it. Remember, when we're doing Fibonacci's, when we push past those highs or past those lows, you sort of have to void your sequence and you have to redraw them. We cover a lot of how to do that in the Fibonacci Counterpunch videos that are in our Elite Trading series. So go ahead and check those out if you want. If you have any questions at all, be sure just to send me a private message and I'll do my best to get back to you. One last thing about the private messages. Unfortunately, I've got 2 messages that I cannot find, and I'm going to do some research in it tomorrow. But if you send me a PM and you haven't gotten a response in the last few days, send it again. Send it again. It'll bump it to the top of my list. I had an incredible number of those coming out on Monday, and I just couldn't find them. Just flat out couldn't find them. So, if you sort of feel like, Shane, you didn't write back to me, I will write back to you. I promise. Matthew, good to see you, Matthew. We're going to go over the Euro-kiwi here in just a second. That was one of the other trade ideas we wanted to follow up on, and that was one I believe you asked about earlier today. So let's go ahead. Check it out. This would be another trade follow-up. RBNZ cuts rates. New Zealand dollar weakens versus the majors. Now, we covered a lot of these pairs during last night's Asia-Pacific preview. I was very excited about the potential rate cut, and that's exactly what we got. We got that big half-a-point rate cut from the RBNZ, and it essentially really let me see. I'm long the dollar yen with the trend rider. Absolutely, Matthew. Then you're doing very well. Listen. What you're saying is it's a pretty good idea. I mean, if you're looking at maybe a strategy like the trend rider, you're looking at a strategy like the trend rider and you're saying, okay, it's going to get me in on a trend. We know the dollar yen is trending. Janet, good to see you, Janet. Let's see, already 2% of the profit. You can't beat that. You know that the dollar yen is sort of trending. Why not apply the trend rider? See if you get an entry. That's putting your thinking cap on. And that's what trading's all about. Bobby Bob, let's see, Kiwi Aussie. Yeah, we're going to go ahead and look at the Kiwi Aussie as well right after this Euro-kiwi. So we got a few things to look at here. That was sort of our trading idea was going to be a sell right up there from the right beneath 182 even, sort of selling up here in our golden zone. And you can see right in there, that's exactly what we want to do here. I'm pretty confident that if we do break 50%, that 180.70, that we're going to get a chance right up there. It seems like it's a long ways away, but it's not necessarily. This has been an incredible market here this month. You're up almost 3%. You know what? We get a little bit more extension up into here. It's going to be a pretty good sell. So do I want to be long or do I want to be short? I don't trade 50%. Maybe in the next life I'll change my mind and say 50% on some of these euro pairs is probably a pretty good trade. But for me, I'm just looking at ways to get long. Let me see. I hope you're not in Florida, Matthew. No, I'm in Dillon, Montana. But we have friends down in Florida, and we wish them all the best. We think that this is going to be a pretty nasty storm. So I hope everybody got out of that Tampa area, and we did have some traders that were down in that area. So. All the best. Haven't heard anything, but hopes and prayers. In any case, 50%, I don't want to sell it. Probably would have made a little bit of money here, but I want to get long. So the idea here on the monthly is we got a sell location up there. That's great. Let's get more current, though. 38% is down there at 179.33. It's about 100 pips away. Let's go down to a 4-hour chart and see what we can do. This isn't bad market structure right here. Not bad at all. Spike low, right there's your big RBNZ move, bang, bang. And then you sort of got a little bit of a market that's creeping down just a bit, and you're going to be doing something like that. So essentially, I'm looking to enter this thing. I love big round numbers. They're one of my favorite things in the world. And right there, you've got one, 180. So I have no problem bidding 180 here on this Euro-kiwi. I think it's a pretty darn good one. I think that that's going to be a nice trade. I really do. So if it comes down, we got the long from 180. Got no problem with that. Maybe 180, 180.01, something like that. I would keep this relatively tight, though. I wouldn't shade that too much, and we're just looking to grab maybe 25 pips off of that. But a better trade, a premium trade, is selling the back end of that monthly golden zone. It's going to give us a nice opportunity to short that. I have a lot of confidence in that level. If we get it, this is a higher risk trade. Definitely is a higher risk trade, but one at 180s, somewhere in there is not bad. How much do you want to risk there? I would probably just go 25 pips, stop myself out underneath 50% here, try to make sure that I don't lose too much on this trade, just in case we get a big sweep lower. I don't think we are, though. I think that the Kiwi is struggling right now, and a lot of that's, well, almost all of it's because of your central banking activity. All right, we had one more Kiwi pair to look at. And it's essentially the same game plan, really the same game plan. We were looking to get a pullback from there. I would stick right with this 4-hour chart and something like that. That's great market structure right there. Spike low, huge breakout to the top side. Why would it go that far? Because you've got the Kiwi, all right, cutting rates, and you've got the Aussie, the RBA held rates. So that right there is just a function of central banks sort of bringing their currencies back into balance. And when you start talking about the Asia Pacific region, you know, you talk about Aussies and Kiwis, that's absolutely huge. That's absolutely huge. Those are the biggest currencies there, along with the yen. So definitely, if we do get a nice big sell-off back there, 110.48 is beautiful. 110.50 would be tough to pass on. That would be a pretty darn good bid. So you'd have an opportunity to bid there. Backing off of this, though, and really looking at where we're at with maybe some of our macro levels, this is a much different scenario than your Euro-kiwi. It really is. You've got a nice big bullish month. That's fine, but we aren't really trending as with regards to, we're on the verge of breaking out and trending, but you don't really have any retracement levels you can play off of here. That's a nice spike high. That was a spike low. I would say that we've already sort of violated all of them. So what I would be definitely to mark on your chart is going to be that yearly high. That's a big level. And then right there, 111.56. So 111.56 is going to be your high right there. I would definitely keep a close eye on that just in case we get up there. I would expect potentially some shorts to come in to the market right in that area. Remember, that's going to be your yearly high for 2024. And then you can see we've got this big epic high right here back from 2022. So a lot going on, guys, right here in this Aussie-kiwi. I would consider shorting right up there from that supply zone. I think you got a chance right up there on that monthly level. Remember, always mark your big key levels. That would be an anchor point for me. Yearly highs, always an anchor point. We're looking at previous month's highs, previous week's highs, and today in the S&P 500, we saw a breakout above the previous week's high, and it was a significant move. Washed out a lot of retail shorts, and it was one of those where it looked like a short was probably going to be the right thing to do, and it broke out above last week's high, and it just rallied. So a lot going on, guys. A lot going on in the markets right now, and the reason why is going to be it's going to be your FOMC minutes. So let's go ahead and get down to business here. We're going to cover our fundamental of the day. Is going to be our FOMC minutes now. Let's see right here. Let me see. Matthew, we got a couple questions here. The hurricane will increase the rate of people with no job. Do you think it will affect the Fed's decisions for a rate cut? I absolutely do. We talked about that yesterday. They were saying that the potential fallout from this hurricane is bigger than anything we've ever seen. We're looking at $157 billion in damage. They've already estimated, and the thing hasn't even made landfall yet. So if you see growing unemployment rolls, you see major catastrophic damage on top of what we've already got in North Carolina, on top of what we already have in areas of Georgia, and also areas of East Tennessee, and also some areas in Florida. That is a major catastrophe, and the price tag on fixing all this stuff is going to be astronomical. I absolutely think that could play into the Fed's decision to cut interest rates. They will never say that in a million years. They can't. That's FEMA's job. That's the government's job. The Feds are supposed to take care of that. They're supposed to make up these shortfalls. And I sort of got heated the other day because we're not seeing that happen. There was a lot of people, there's no money left. There's this, that, the other. That's inexcusable. believe me, the Fed could come in and cut interest rates, if for no other reason than to maybe lower some of that stuff on T-bills to where maybe the federal government can afford to finance some of this stuff. And that's exactly what we're going to see. I'm sort of out on a limb there, but I think that that's probably the way it's going to go. And right now it's just I was just down there 3 weeks ago. It's amazing to see what's happening. In any case, Bobby Bob, Hurricane Milton is going to affect the markets. Absolutely, Bobby. I think that you're going to see the U.S. dollar lose a little bit of its recent strength, but we're just got to wait and see what happens here. It's supposed to hit as a Cat 5, which is an epic storm. We don't really know, though. It's supposed to hit tonight. All right, we got one more question, then we're going to get on with the FOMC Minutes. Let me see. Mike, hi, Shane. It's MD. Confident you're doing well. I saw you were live on YouTube. Moved to futures trading, and it's doing really, really well. Well, I tell you what, futures trading is my bread and butter, Mike. It's one of those things that I like futures more than I like OTC markets like the Forex. But if you're trading the Forex, that's okay. Just be sure you account for your spreads. Make sure your broker's regulated in your local, not in your local municipality, but make sure there is some sort of oversight. And also your spreads, you need to be watching those spreads. You need to be watching your commissions in the OTC. I go to the futures because I like futures products that are cleared through an exchange. To me, that's absolutely huge. That gives me a shot at potentially knowing what the price of something is at a given time. So I'm absolutely fantastic. I'm glad to hear that you're having some success in futures. For me, that's what I trade 90% of the time is futures. But one of the things about futures, you can't carry things overnight without having more leverage money unless you trade micros, which is fine. But OTC markets, you really can, so you don't get hit too bad with having to have a lot of money to carry them overnight. That would be probably the only thing I'd say is a bonus of the OTC markets. That being said, if you're making money trading Forex, well done. Well done. Love your new setup. Thanks, Mike. I appreciate it. All right, guys, let's go ahead and get on with it. We've got some pretty good stuff here. FOMC Minutes was it. RBNZ interest rate decision. We cut that by a half. We already covered that. That was sort of came in as expected. But look at this. Interest rates are up today. Now, NBA 30-year mortgage rates are a big deal to me. I look at the folks that are writing 30-year paper as being those folks that are trying to prognosticate and say, hey, where are interest rates going to be, a year from now, next year, 18 months? And we've seen these tick higher significantly week over week. And why did that happen? It's because we had the blockbuster NFP. We had the blockbuster NFP report, and I'm going to show you on the FOMC Minutes why we believe that those rate cuts were warranted. But this FOMC Minutes report that we're going to go over right now, it's almost obsolete. I mean, it really is. It's almost obsolete. So we've got to really remember that things change so fast in the markets that, you just about the time you think you have things nailed, it just moves on. Things move so fast. And that's exactly what we're going to see from these minutes. So I'm sort of looking at the DXY. We're seeing a rally in the DXY right now, the dollar index. And the reason why is we don't believe that we're going to get that 0.5 point rate cut at the next meeting. And you can see right here, these mortgage rates spiking 1/4 point. That's 1/4 point in a week. That's big. That really is a big deal, and that reflects the strength of the dollar. You'll notice right here for this month, we're up about 2% on this DXY. We're only about a week deep into October. Absolutely huge, really a significant rally. 38% was a big level for us, and I sort of pointed that out. We had a spike high there, a spike low. You had a real nice 38% at 102.60. You can see exactly what happened there. You had great compression. This is sort of the long-term signature, but what did we have right there? Friday, October 4th, NFP. As soon as NFP came in at 254,000, we saw the dollar rally because we knew that the Fed more than likely was going to say, whoa, maybe we were too hasty. Maybe we were too hasty cutting rates by 0.5 point. There was your rally. That 38% was a bear. Great trading. And then we finally broke. So you're starting to see that dollar really strengthen. So you're going to want to be aware of that. Be aware of that. That's sort of why I was saying get long on that dollar yen. As far as the dollar Swissy, that pendulum trade, that's a different animal. The Swiss franc with this much geopolitical uncertainty and the storm bearing down on the United States, I would be hard-pressed to bail on the Swiss franc. That's for sure. So let me see, Matthew, do you have any courses for futures? I did a few videos and shorts on futures, but it's something that we're talking about. But I talk about futures every day, so just tune in. If you have any questions, just send me a private message, and I can typically point you in the right direction. That's for sure. But this DXY, you can see we're on the rally. So, big picture, what do we want to get accomplished here today? Well, we want to try to get an understanding of where the dollar is going. This right here was it. This is FOMC minutes. Fed officials were divided on whether to cut rates by a half point in September. The minutes show. So the idea is that you had that division in there for the half point rate cut, and then you saw the big NFP come in. Tomorrow we're going to have CPI live for you. I'm going to be up bright and early, and we're going to be talking CPI, inflation. We're going to do it live. And, it really comes down to tomorrow's figures. If we get a hot CPI, if we get hot inflation plus a hot jobs market, not only may we not get a half a point, we may not get a quarter point rate cut. We might get rates held right where they're at. Because if employment's robust and pricing stability and you still have inflation, persistent inflation, you're not going to cut rates by a 0.5% or maybe even 0.25%. There's still a lot of uncertainty in these markets, and that's why you're seeing that big rally out of the U.S. dollar here for the first week of October. We thought we were going dovish for the rest of the year, and we're not necessarily doing that. It's not necessarily the case. So FOMC minutes right here. This is what it looks like. This is the release. You can sit around and read this stuff and do whatever you'd like to do with it. I'm going to point out a few things that are jumped off the page to me. Be honest with you, I've read enough of these reports to where it's all, to me, the most important part of any of this stuff is figuring out exactly how the market's reacted to the words, not necessarily what the words are themselves. But we do want to have a decent understanding of what they said and what the argument and the tone is in that FOMC boardroom. These are the people that make the markets. They make policy. And if we have an idea of what they're thinking, perhaps we can be smarter than the average bear and get out ahead of some of the other folks that are in the markets that are chasing our dollars. All right here, you can see developments in the financial markets and open operations. Don't really care about that paragraph. What I do care about is why exactly they cut rates by a 0.5 point. I thought it was way too aggressive. I thought the inflation stuff was not even remotely under control, and I thought it was a bad move. Well, let's see what happened here. Staff review of the economic situation. All right, you can see right here, information available at the time of the meeting indicated that real gross domestic product expanded solidly. The pace of job gains continued to moderate since the beginning of the year. That's out the window. We're not moderating now. We had a big gain in jobs according to the numbers that came across the board. So already this is outdated, and that's why you're starting to see that ricochet in the U.S. dollar. In any case, consumer price inflation was well below its earlier rate, but remains somewhat elevated. Now, right here, this is important to us because CPI is coming our way during tomorrow's U.S. pre-market hours. Consumer price inflation, as measured by the 12-month gauge and the price index for personal consumption expenditures, was lower in July than it had been in March, which had followed some high month-over-month changes in the beginning of the year. Monthly changes in PCE price since April had been smaller than those seen in the first 3 months of the year. On a 12-month basis, total PCE price inflation was 2.5%, and core PCE, which excludes energy and consumer food, was 2.6%. In August, the 12-month change was 2.5%, and core was 3.2%. Basically, they're saying that we're on the right trajectory with inflation. So the idea here was jobs came down, inflation's coming down, we're going to cut interest rates because everything's great. Boy, I don't know. And tomorrow's going to tell the tale. CPI is going to be a huge market mover tomorrow, so be careful. And this is the last one. Staff review of the financial situation. The market implied path for the federal funds rate declined notably over the intermeeting period. There you go. Options on interest rate futures suggested that market participants were placing higher odds on greater policy easing by early 2025. So what they're saying is the markets are pricing in big rate cuts, and we're thinking that our prime rate, which is the federal funds rate, can come down over time and not hurt employment and still keep pace with your inflation. That's why they cut by a 0.5 point. hopes for children and losers. I hope they're right. I'm tired of paying a fortune for loaves of bread and milk at the store. So right here, let's take a good look at gold. So what happens to gold when we see the dollar rally? You see a big sell-off in gold. That's exactly what we've seen this week, off about 1.67%, excuse me. And we get right down into that beautiful area. We've had this one outlined. This has been on our map for a while, 2603. It was a great trade again today. I mean, if you got a chance at it. Yesterday we came off, just crushed that number. That was a great trade. It really was. 206.04. We were talking about buying 05s, buying 0750s. Go back, take a look at the live streams. Got a real nice bounce there, and then we came right back down there again today. Our low is about 2605, 2605, and you can see you've just been in scalping heaven. Absolutely scalping heaven. So for me, I take a look at that and I go, wow. That level is serious business. 2605, absolutely love it. That's a good one. That right there was a good one. So if we're looking at this and we're saying, okay, what could happen next? I would be very careful with that level. We've already hit it twice or three times. We know we've got the dollar rallying and we've got CPI coming on. If you wanted to play a breakout beneath 2600 even, I would say, okay, go ahead and do it. I'd say sell 25.99s and give it a shot, because if you get a hot CPI number tomorrow, that market's going to come off in a big way. So be careful with gold. If you're holding long, listen, I'm still bullish gold, but right now going into CPI, I don't know that you hold long gold. You could really get hurt. I personally, perfect world, that 26 has been great. If in fact we were interested in taking another long trade, you could say right down there in your golden zone, 25.53, maybe 25.60. That would be a great trade right in there. Golden zone action, maybe 25.57, 55, somewhere in there. That could be a position trade that we could actually say, okay, there's the deep pullback, knocked out a lot of retail longs, and now we've got a chance maybe to get with those market makers, because in my view, they're still playing long gold until 27.50. The geopolitical situation and the idea that the Fed is gonna loosen policy over the next 12 to 18 months, more than likely is going to drive gold to 3,000. I don't really see a case where you get that massive correction unless inflation spikes and we start seeing maybe just the rates stay the same or a panic rate hike. But that's how you trade it right there. If you want to trade a breakout beneath this 2603, I would sell beneath 26 even. You're probably going to get a washout down to this 50% area. Or if you're holding longs, stop yourself out underneath that 38%. Because remember, if that market breaks, we could really sell off in a big, big way, and it could happen fast. So something to think about there. If you're a gold trader, I know most folks on this stream are. All right, guys, we got one more market and one more fundamental to cover, and then I'm going to call it a day. It has been a long one. It's been a long one. All right, EIA crude oil inventories came in. Crude oil stocks are up. Take a look at the report. U.S. commercial crude oil inventories, excluding those in the Strategic Petroleum Reserve, increased by 5.8 million barrels from the previous week. That's good. That's what we expect to see in the fall. That's typically a bearish market driver for WTI crude. Not really what happened today, and I'll show you what happened to price here in a second. But here's the kicker for me, and this is what I'm watching the rest of the fall and into the winter going into 2025. Now, we know the election's a market driver. Right now, we've seen a shift in the polls. It's starting to look like it's a 50-50 split. Harris was comfortably ahead on most of the polls for about the last month since the DNC, maybe the last 6 weeks. But Trump's actually reestablished a lead in some of these polls. It's very, very tight. We don't know what's going to happen. Harris is going to be bullish for energy prices because that production is going to come offline. A lot of it is. And Trump's going to be bearish because the drill, baby, drill, and getting the oil to market is a big deal. So yeah, you bet, Janet. You're welcome. In any case, right here, 4% below the 5-year average. Going into 2025, I'm watching that closely. If we can't close ground on the 5-year average and get those stocks up a little bit, specifically when you're going into disaster, when you're having big natural disasters, when you're having potential war escalations out of the Middle East, it really spells towards an incredible bullish year for gold or for crude oil in 2025. Now, I've been saying that for a couple of years now, but I stand by it. We're trading just right around $75, $73.38 going into the winter months. That's astounding. That's absolutely astounding. We should be trading much, much lower than that, trading false seasonality and trading wintertime pricing, and we're not. So for me, I'm still, sort of bullish, even though this time of year we should be bearish. This is sort of the area that I outlined earlier today. I think I put that out on X, something down here right around 71 and a quarter. Still love that bid, 62% area, 70 and a quarter to 70. 71 and a quarter to 70.96. That's pretty good downside support. How do we trade it right now? Well, I mean, you could do a lot of different things. You could wait for price to get reestablished up over 74 and bid and just sort of hold longs and see if this market grinds higher. From a practical standpoint, I probably would be looking maybe to wait for price to get confirmed, like a daily close up above 74. And then I really wouldn't have a problem taking a shot at maybe 75 or 78 to the top side, just because we do have some reasons for bullish crude oil. Now, the Hurricane Milton is not supposed to knock a lot of output in the Gulf of Mexico offline. It's not supposed to. This storm is supposed to turn and hit Tampa in the Gulf Coast region, that Louisiana, that area, and up in the Panhandle. Maybe a Panhandle of Florida may actually be spared by this storm. If in fact that's the case, then we shouldn't see a huge disruption to the Gulf oil drilling. However, it's very important to understand that anytime there's a widespread disaster, crude oil is always in demand. Energy is always in demand. So we got to be very careful with what we do right now. As far as what I think, that's a big report, 5 million barrel build. We should see a bit of a sell-off, and we had a pretty good sell-off today. Our low, 71.58. We just missed it. We're getting down there at about 71 and a quarter. We just missed it by 33 ticks. So a little bit disappointed there. I was hoping to get maybe a bit more of a draw there and get the bid. But as far as a weekly chart goes, really isn't much help. If you want to look at the 30-minute chart, what happened today, what do you got? Nice big sell-off there during the overnight, and then right there on that traditional NYMEX open, big sell-off, and then we sort of bottomed out, and then you saw your numbers, your EIA numbers came across. It should have been a bearish market driver, and it wasn't. It just drove a tremendous amount of volume to the market and drove us higher. So right now I'm in a holding pattern with WTI crude. I would wait for this to get established back up above 73.86, maybe get a daily close above 74, and then we can start talking about maybe bidding this market and trying for a little bit more money here. Something to think about there. All right, guys, I want to thank you for joining me here today or this evening for the Asia Pacific preview. I'm going to be back on here in about 12 hours or so. We're going to be back for CPI Live. We'll go ahead and unpack exactly what the release is supposed to be, and we're going to do some live trading as well. Probably pull up the DOM. I want to get that 9 EMA going, maybe on a 1-minute chart, and see if we can't build a trade or two live and maybe get into a hot trend. I'm optimistic that CPI is going to come down a little bit. That's really going to skew our dollar expectations, but I'm not necessarily sure, and I don't think anybody is. So we're going to be watching that closely. So we'll be back here, 13 hours from now or so. I got to get some sleep, and then we'll show up a little bit early, about 10 minutes early, and then we'll get in. We'll preview CPI. We'll talk about what it can do to the dollar, and then we'll line up our levels. We'll be watching gold closely. Be careful if you're holding gold longs. Even though I'm bullish gold, be careful underneath 2,600. Be careful. If the market takes out 26, that 38%, more than likely you're going to see it crash to 78, somewhere down in there. All right, everybody. I want to thank you for joining me. Bobby Bob, good to see you. Dragon, always a pleasure. Barnacle, maybe Janet, Bryn, maybe we'll have to do some more of these Asia Pacific previews. I always enjoy them. Mark Corp, see you bright and early tomorrow, Shane. Yeah, guys, let's make a little bit of money tomorrow. I think it's going to be fantastic, and it's good to see you, Mike, over on YouTube. So, all right, everybody. Until next time, trade the action well, and we'll talk soon. See you.